Here is the fully rewritten human-sounding script. No overdramatic lines, no AI filler phrases, just clean, natural delivery with a strong hook. You know what's interesting? Bitcoin was sitting above $65,000 just yesterday. Today it's struggling to hold $63,000. And most people watching this are blaming crypto. But the real story has nothing to do with crypto at all. Welcome to XRP Future Finance. Let's talk about what's actually going on. The drop in numbers. So here's where things stand right now. Bitcoin traded around $63,640 on Tuesday, down about 0.9% over the past 24 hours, and off 3.3% for the week. It touched $65,076 on Monday, and then sold off through the session. That kind of move, from $65,000 to below $64,000 in less than a day, gets people nervous, and honestly it should get your attention. But before you start reading too much into it, the broader picture matters a lot here. This wasn't Bitcoin doing something on its own. Every major asset in the crypto market moved lower in that same window. And when you see that kind of uniform selling, you know the pressure is coming from somewhere outside the space entirely. Altcoins across the board. Ethereum fell 0.9% to $1,719 and is also down 3.3% on the week, nearly identical numbers to Bitcoin, which tells you this is not project specific. XRP dropped 1.6% on the day and is sitting on a 9% weekly loss, which is something holders should be paying attention to. Solana pulled back 3.4% to $71. Dogecoin lost 6.6% over the past 7 days. The losses were spread across every corner of the market, regardless of use case or ecosystem. That kind of uniform decline is a signal. It means investors aren't making decisions about individual tokens right now. They're making a broader call about risk, and they're pulling back from it across the board. One token moving differently. There was one notable exception in all of this, and that's Tron. While every other major asset was sliding, Tron gained 1.3% on the day and posted a 4.6% gain on the week. That's worth pointing out not because it changes the broader narrative, but because when one asset breaks away from a correlated sell-off, there's usually a reason. Whether it's an ecosystem development, growing adoption in specific regions, or a shift in how certain investors are positioning around it. Tron's performance this week stands out, and it's something worth keeping an eye on going forward. Meanwhile, Hyperliquid's HYPE token gave back 4.8% on the week, falling in line with the rest of the market. Where the pressure is actually coming from. Now here's the part that explains everything. This sell-off did not start in crypto. It started in the stock market, specifically in technology and chip stocks, which have been the biggest winners of 2024. A major index tracking Asian equities fell more than 2% after recording an all-time high just the session before. South Korea's Kospi dropped more than 6% in a single day. The reason? Investors are starting to question whether the rally in semiconductor companies has pushed valuations to a point where they're no longer justified by the fundamentals. When that kind of doubt enters the room in one major market, it travels fast. Capital that was sitting comfortably in high-growth, high-risk assets starts looking for the exit, and that includes crypto. U.S. futures feel it too. The same pressure showed up in U.S. markets. S&P 500 futures dropped 0.8%, and NASDAQ 100 contracts fell 1.3%, reflecting a pullback from the large-cap tech names that have been driving returns all year. Bond yields moved higher at the same time, which tends to weigh on both stocks and risk assets more broadly. Higher yields make safer investments relatively more attractive, so money moves away from growth. Brent crude dipped below $78 a barrel, and gold also retreated. When you see a day where tech stocks, commodities, and crypto all move lower together, that's not a coincidence. It's a unified repricing of risk, and it affects everything that investors have been holding in the growth side of their portfolios. The Iran story is done. AI is running things now. Something else shifted this week that's worth naming directly. For a while, Bitcoin was essentially tracking the Iran situation. Anytime headlines suggested escalation in that region, potential conflict, oil supply concerns, geopolitical tension, Bitcoin moved. And when things calmed down, Bitcoin relaxed. That dynamic has mostly played out now. A peace roadmap is in place, oil prices have come off, and the geopolitical risk premium that was showing up in Bitcoin's price is largely gone. What's running the show now is the AI trade. Specifically how investors feel about the technology rally that's been carrying global equity markets higher all year. Crypto has become closely correlated with that trade. When confidence in the AI growth story is strong, Bitcoin and altcoins tend to benefit. When that confidence wavers like it did this week, crypto feels it just as much as any tech stock. Micron's earnings are the next signal. The clearest near-term test of that AI sentiment is Micron's earnings report, due Wednesday. Micron makes the memory chips that power AI data centers and large-scale computing infrastructure. Its stock is up more than 300% this year on the back of surging demand from AI companies. So when Micron reports, what the market is really trying to gauge is whether that level of spending on AI infrastructure is sustainable. If Micron's numbers are strong and its guidance is confident, it signals that the AI build-out is still accelerating, and that would likely give both tech stocks and crypto a reason to recover. If the results disappoint, or the company's outlook turns cautious, it could extend the selling we've been seeing this week. Wednesday is a meaningful day for anyone paying attention to the macro picture. 3 reports that will define the next month. Looking further ahead, a digital asset research firm called Bitfire Group Holdings put out a note flagging 3 specific macro events over the next 4 weeks that could move markets. The first is the U.S. June jobs report on July 2nd. That report tells you how the labor market is holding up, how many jobs were added, whether unemployment is rising or stable, and whether wage growth is still pushing inflation higher. It's a direct read on the health of the economy, and it influences how the Federal Reserve thinks about interest rates. Strong hiring usually supports a more cautious Fed. Weaker numbers can open the door to rate cuts, which historically have been supportive for risk assets, including crypto. Inflation data on July 14th. The second event is the Consumer Price Index on July 14th, which is the Fed's preferred measure of inflation. This one carries a lot of weight right now. The entire conversation around when the Fed will start cutting rates comes back to this number. If inflation continues to cool toward the 2% target, it gives the Fed room to loosen monetary policy, and looser conditions tend to be good for Bitcoin and the broader crypto market. If inflation proves stickier than expected, the Fed holds firm, rates stay elevated, and the headwind for risk assets continues. The July CPI reading could genuinely shift the market's entire rate cut timeline in either direction, which is why it's one of the most closely watched releases of the summer. Earnings season and the AI guidance everyone is waiting for. The third catalyst, and possibly the most impactful over a longer horizon, is the start of second quarter earnings season in mid to late July. It opens with the big banks, which give you a read on credit conditions and consumer spending. But the reports that matter most for market direction are the large AI companies: Microsoft, Alphabet, Amazon, Meta, Nvidia. When those companies talk about what they're spending on AI and where they see that investment going through the rest of the year, it shapes the entire risk appetite of global markets. If their forward guidance is confident, the AI trade gets another leg up, and crypto likely benefits from that enthusiasm. If they pull back on expectations, the repricing we've seen this week could continue for longer. What XRP holders should be thinking about. For people who follow this channel specifically because of XRP, the 9% weekly drop is probably the number that stings most this week, and it's fair to sit with that for a moment. A 9% weekly move is meaningful, but it helps to put it in context. XRP isn't falling because something went wrong with the project, it's falling because the entire macro environment is in a risk-off phase, and altcoins tend to feel that more than Bitcoin does, simply because they carry more volatility by nature. The fundamental case for XRP, the payments infrastructure, the regulatory progress, the growing use of the XRP ledger in real-world financial applications, none of that has changed this week. Price and narrative are two separate conversations, and the price action right now is being written by macro forces, not by anything specific to XRP itself. Crypto is now part of the bigger system. One thing this week makes very clear is that crypto doesn't trade in its own bubble anymore. There was a time not that long ago when Bitcoin would do its own thing regardless of what was happening in equities. That's not really the case at this point. Institutional money is in the market. Bitcoin ETFs have brought in a new class of investors who also hold tech stocks and S&P 500 funds. And digital assets are increasingly treated as part of the same risk-on, risk-off calculation that drives all global capital flows. That's actually a sign of the space maturing, but it also means you need to pay attention to the macro picture in a way that wasn't necessary 5 or 6 years ago. What happens in Seoul's stock exchange, in U.S. chipmaker earnings calls, and at the Federal Reserve now has a direct line to Bitcoin's price. That connection is only going to deepen over time. Staying level-headed through the dip. Down weeks like this one tend to bring out a lot of noise. People calling tops, people calling bottoms, people making predictions that feel very urgent in the moment and very forgettable 3 months later. The most useful thing you can do during a period like this is focus on the actual data points that will tell you where the market is heading. And we laid out 3 of them today. Micron Wednesday, jobs July 2nd, inflation July 14th. Those aren't opinions or predictions, they're scheduled events with real numbers attached to them, and the market's reaction to those numbers will tell you more than any chart pattern or social media thread. Tune out the noise and track the data. That approach doesn't make for exciting content, but it makes for better decisions. Wrapping up, so that's today's breakdown. Bitcoin is off towards $63,000. The whole crypto market is in the red, and the reason has nothing to do with anything that happened inside the crypto space. It's a macro story. Tech stocks getting reassessed, AI sentiment wobbling, investors pulling back from risk in a coordinated way across global markets. The 3 catalysts coming up over the next 4 weeks will go a long way toward telling us whether this is a short breather before the next move higher or the beginning of a more sustained consolidation. We'll cover every one of them as they land. If you found this useful, hit like and subscribe so you don't miss the follow-up coverage. Drop a comment with your thoughts on where you think Bitcoin goes from here. We read every single one. See you in the next one.